Today, will APRA crimp mortgage lending? The DFA Daily to the 15th of March 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and property news with a distinctively Australian flavour. Well, the question, of course, is will there be more restrictions on loans, particularly for mortgages, down the track? The ANZ Chief Executive has predicted that financial institutions could be forced to cut back on higher risk mortgage lending at some point as low interest rates drive home prices skyward and regulators fear the market will overheat. ANZ Bank Chief Executive Shane Elliott said that with Australian house prices rebounding from the COVID-19 pandemic, property prices would remain, quote, well supported, which could eventually force policymakers to take action, as has occurred during previous housing booms. Elliott told the Sydney Morning Herald that demand in the housing market was strong because of ultra-low interest rates, and the Reserve Bank has made it clear that it intends to keep rates low for some time. That will lead to asset price inflation. We're already starting to see it, he said in an interview with the Herald and the Age. Elliott said that there would be some concern on the part of financial regulators about the risks of banks lending against high-priced assets and worries about first-home buyers being locked out of the market as prices rise. New Zealand recently instituted caps on loans with smaller deposits, and Elliott said that Australia might eventually take a similar step. Just based on what we know today, you would have to say it's more likely than not at some point, he said. I don't think it's immediate. I don't think it's going to happen this week. It may not even happen this year. Elliott told the Herald that the type of policies that could be implemented include restrictions on loan-to-value ratios and possibly debt-to-income ratios. But Elliott stressed that there were not yet signs of more irresponsible lending by banks. And he said he didn't think the market was in bubble territory. The Herald also reported. Well, he and I would disagree on that. And picking up on that theme, there was a piece in Livewire by Jonathan Rushford titled RBA to APRA. We've set house prices on fire, now you fix it. And he laid out some of the regulatory options that are available to APRA, noting that house prices and borrowings surged in the last few months, as well as the hangover from the shutdown of several industries due to COVID-19 concerns. Systemic risk is growing, he said. It seems it is now just a matter of time as to when and how APRA acts to address these financial stability concerns. And there are indeed precedents in Australia and overseas for various measures, each with its own benefits and costs. So the first he talked about was high LVR lending restrictions. New Zealand is implementing restrictions on owner-occupied loans with less than a 20% deposit and investment loans with less than a 40% deposit. High LVR loans are far more likely to default and far more likely to cause lenders to suffer a loss. Lenders' mortgage insurance is only a partial protection. The experience in the UK and in the US has shown that if a house price downturn is severe, insurance may not have sufficient wherewithal to meet claims in full. The second is to consider debt-to-income ratios. The UK has implemented restrictions that limit the amount of loans lenders can make where the proposed debt-to-income ratio exceeds 4.5 times. Like limiting high LVR lending, this will reduce the ability of borrowers to gear up and thus reduces their firepower to purchase. The third thing they could do is to consider affordability rates. When assessing whether a borrower can afford a loan, lenders use a buffer over the current interest rate to test that the borrower can meet repayments if interest rates rise. Lenders often use a 2.5% buffer, but APRA could require that this buffer is increased, which would also reduce the amount of debt potential borrowers could take on. A sidebar there, of course, APRA only relatively recently reduced the buffer. The next one would be to look at loan growth rates. Back in 2014, APRA instructed lenders to cap the growth of their loans to investors at 10%. This turned out to be a goldmine for lenders, as they were able to increase the interest rates charged on investor loans to reduce their demand. The current surge in house prices appears to be driven more by owner-occupiers, so this measure is less relevant this time around, but the previous experience is a guide to what could happen if APRA placed caps on higher risk loans, with banks likely to use high interest rates to ration their capacity. Then they could consider capital weights for higher risk loans. On its own, or in conjunction with restrictions on higher risk loans, APRA could increase the capital weights on these mortgages. If banks were facing a greater difference in capital costs for higher risk loans, they would likely respond by creating tiered pricing that rewards lower risk borrowers. Actually, that is already happening, because today, if you have a higher deposit, you can get a better rate. 6. There's the question of the TLAC, or Tier 2. APRA has been unduly slow in implementing the total loss absorbing capital, the TLAC requirements. Given the extremely low cost of issuing Tier 2 debt, which is often called subordinated debt, currently APRA could significantly reduce the risk of a disorderly bank failure by shortening the implementation period. The protestations by banks several years ago that the global market could not stomach a substantial increase in Australian Tier 2 debt has been shown to be completely bogus, with recent large deals heavily oversubscribed. Any banks complaining about such a change can be reminded that they've benefited enormously from the TFF, and this is a minor cost imposition in comparison. Then they could consider countercyclical capital buffers. In APRA's own words, the primary purpose of the countercyclical capital buffer is to increase the resilience of the ADI sector during periods of heightened systemic risk. Now, those 7 measures aren't exhaustive, but it's likely that a combination will be used in the medium term. The limits on higher risk loans, high LVRs and high debt-to-income ratios, are the most practical measures to stop borrowers from taking excessive risks, given speculative investment activity is booming. These measures may be argued to be locking some first home buyers out of the market, but those potential buyers need to hear the hard message that without sufficient savings and income, they will run the risk of being forced sellers at a time when house prices are falling. The recommended adjustments on TLAC and the countercyclical capital buffers are likely to be seen as a prudent response from a regulator that has a history of being appropriately conservative. While banks might quibble at these changes, it's clear that the systemic risks are building and that action should be taken. These changes would have minimal cost impacts on banks and borrowers relative to the excessively generous benefits they've already received from the RBA's easy money policies. And indeed, I already argued previously that APRA should have already imposed counter-cyclical buffers. And then, of course, they said, well, of course, with COVID, now we can't do any of that. But frankly, that is just an excuse which is not very acceptable. So we may expect to see some actions from APRA, but frankly, I think it's going to be quite a long time before they come to the party. They've always been slow, they've always been conservative, and in the meantime, the banks will continue to make hay. And meanwhile, according to MPA, ANZ quietly brought back distressed mortgages from its securitised trusts amid the COVID-19 crisis, possibly breaching prudential standards and drawing a rebuke from the bank regulator. During May and June, ANZ bought back $89 million worth of stressed mortgages from securitised trusts, which are packaged as mortgage-backed bonds and sold to investors. The bank made the admission weeks after it was reported that Commonwealth Bank had also bought back $80 million worth in home loans between March and July, on the theory that interest was being capitalised on the deferred loans and it would be best to buy them back rather than breach the rules of the trust. The securitisation market froze in the wake of the global financial crisis as investors grew nervous about the strength of home loans in their portfolios. And while the domestic market has revived in recent years as interest rates have fallen and lending losses have stayed low, it is still well below pre-GFC peaks of nearly $200 billion. Packaging home loans into mortgage-backed securities helps banks remove risk from their balance sheet, but the Australian Prudential Regulatory Authority only allows lenders to repurchase mortgages from their securitisation under certain conditions, including that the borrower is in good standing. And when it learned that some lenders were buying back COVID-deferred home loans, APRA sent a letter ordering them to stop, saying the buybacks provided implicit support for securitisations which breached regulations. APRA has recently identified that some authorised deposit-taking institutions repurchased residential mortgage loans that were subject to repayment deferral from their securitisations, the regulator said in the letter. APRA said that the move represented implicit support, which was inconsistent with prudential standards. Both ANZ and CBA halted the buybacks when APRA released the guidance in July, according to the Australian. APRA is now holding ANZ to closer scrutiny when it comes to the bank's securitisation programs. Going forward, in addition to this disclosure, APRA requires ANZ to obtain additional external review of its securitisation programs prior to issuing any further RMBS, using an independent assessor and with a review scope to be yet agreed with APRA, like I said, ANZ. And it's worth underscoring, of course, that people have been citing the very low delinquency rates within the mortgage-backed security portfolios, but if the banks have been buying back loans, then the real position may be rather different. Elsewhere, consumer groups slammed the Senate report on lending laws, which I discussed in my post yesterday, which was aimed at Labor and the crossbenchers. Alan Kirkland, the CEO of Choice, said this report ignores the clear economic evidence that the housing market is already overheating, and removing safe lending laws will push home ownership out of the reach of many more Australians. We already have seen high levels of mortgage stress in states like Queensland, South Australia and Tasmania. Giving more power to the banks in these circumstances will be bad for people who are already struggling to repay their mortgage and bad for people trying to get into the housing market, he said. We hope that the rest of the Senate will see beyond the political spin and focus on the evidence that we need safe lending laws now more than ever, Kirkland added. And similarly, Gerald Brody, the CEO of Consumer Action Law Centre, stated, one bad loan won't break the bank, but it can definitely break the borrower. That's why we need to keep our safe lending laws. Without them, the regulatory focus will be on stability of banks, not the protection of borrowers. Mr. Brody said he believed the bill would abolish a borrower's right to legally challenge a lender's decision, a premise dismissed by the committee, by the way, and would remove the role of ASIC in overseeing most bank lending. This directly contradicts the Banking Royal Commission, which said that the existing law should not only remain but be better enforced, he posited. The government's plans will dismantle our effective and sound financial services regulatory framework. The reality is that the prudential regulator APRA does not provide individual consumer protection. It focuses on whether loans cause a credit risk to the bank, not on whether loans are affordable to individual borrowers, he said. And Karen Cox, the CEO of Financial Rights Legal Centre, also criticised the move, stating safe lending laws in this country were carefully crafted in response to real harm from unchecked lending. The Banking Royal Commission reinforced the need for them only 2 years ago. This bill will take consumer protection backwards by a decade, let the banks off the hook again and expose ordinary Australians to yet more crippling debt. This plan to roll back responsible lending was concocted as a knee-jerk response to the pandemic-related recession. Now we are facing record lending levels and runaway property prices. It's time to drop this crazy plan and avert a potential debt disaster. She concluded the provisions in the government's bill, which claim to improve protection for vulnerable people against predatory lenders, have been watered down to be worse than the law as it stands. this part of the bill is not going to work, and as government subsidies end, the sharks are already starting to circle. And Fiona Guthrie, the CEO of Financial Counselling Australia, stated that she thought that the majority report was so disappointing. The effect of irresponsible lending on everyday people is enormous. It sends too many people into debt spirals, which often leads to financial stress, family breakdown, mental health issues, and even homelessness. We are pleading with senators, especially the crossbenchers, to block this bill. Please don't make it harder for financial counsellors to help the most vulnerable people, she urged. And meanwhile, the debate rages about the impact of the withdrawal of support at the end of March, including JobKeeper, mortgage repayment holidays and others beside. My surveys suggest that the SME sector will be hardest hit, and the discount air tickets might help the airlines but will do little to help on the ground. That said, the new government scheme to help SMEs gain access to loans will aid in staving off administrations, according to Credit Watch. The plan will see a shift away from the JobKeeper model, which is due to expire on the 31st of March. Instead of directly contributing to businesses, Canberra will now encourage banks to make loans to SMEs by backing up all qualifying loans up to 80% of their value. The scope of businesses that can apply will be enlarged too, with the upper threshold for turnover raised to $250 million from $50 million, and the maximum loan size increased from $1 million to $5 million. Repayment plans will be extended as well, allowing SMEs more time to pay lenders back. JobKeeper was essential in securing millions of jobs during the lockdown period, said Harley Dale, chief economist at Credit Watch. However, with the vaccine rollout underway and the gradual suppression of the virus across Australia, we're starting to return to normality. The new SME loan scheme is reflective of this transition period and is a step in the right direction from the government as the Australian economy returns back to life. Credit Watch, who monitors administrations, thinks that the scheme will help SMEs to remain solvent during the next 12 months. Something rather than nothing was needed for businesses post-JobKeeper, and the flow of credit into businesses will likely lead to fewer administrations in the short term, said Dale. However, the extension of the scheme is a continuation of the camouflaging effect that JobKeeper caused, and there will be some risk that businesses taking advantage of the scheme won't be commercially viable down the track. For now, though, the scheme should provide SMEs with breathing space to adapt and grow their businesses. As supply becomes less constrained and demand begins to pick up, the policy will be welcomed with open arms from the business community. Clearly, there are sectors that will continue to struggle regardless of the domestic economy opening up for reasons beyond their control. For these types of businesses, particularly those in the tourism and hospitality sector, they'll benefit hugely from further targeted assistance, which the government has already hinted at. Frankly, this may help some, but many are not in the position to take on more debt, and I think they may prefer to roll over and close. We'll see. And finally, almost 1,000 apartments worth more than $500 million are the subject of fix-it orders under a crackdown by New South Wales Building Commissioner David Chandler. The orders relate to 10 developments, 9 in Sydney, which have issues ranging from shoddy tiles, cracked slabs, death-trap car stackers, fire safety issues, concrete cancer risks, and waterproofing problems. But 2 developers are now trying to overturn the orders in the Land and Environmental Court. Since Better Regulation Minister Kevin Anderson secured landmark building reforms in September last year, Mr Chandler issued 10 developers with 17 orders to either fix work, stop work, or prevent them from getting building occupation certificates. The orders are aimed at restoring buyer confidence following the discovery of major building problems in the Opal and Mascot Towers in December 2018 and June 2019, which left people homeless and their apartment values plummeting. The reforms also seek to have problems identified and fixed before people move into new developments. None of the developers cited are major brands, although Mr Chandler has issued warnings to Tier 1 and Tier 2 developers, the largest companies working on projects worth hundreds of millions of dollars. Real estate agents advertising for 2 of the 10 buildings in Forrester and Linfield both spruik quality in either their finishes or overall construction, and the online ads make no mention that the developers of these properties have been served with building work recertification orders. Mr. Chandler's office has also audited the occupation certificates of 67 projects, handing out just one fine. And Mr. Anderson said further reforms coming in on the 1st of July will make the industry more accountable for their work. No one deserves to have the great Australian dream of home ownership turn into a nightmare of defects and plummeting values. So I've made sure that builders will be accountable when the work is not up to scratch, he said. To which I reply, yes, but be careful. There are many, many buildings already fully constructed and occupied with defects, and many strata owners are now faced with considerably higher costs than expected. So this is trying to stem the tide, but we have a long way to go, not just, of course, in New South Wales, but nationally. So if you stand back and think about the risks from mortgage lending, the issues with regard to the transition after March, and the issues in the construction sector, and you can see that this is a complex tapestry of interrelated factors which will continue to bear on the economy more broadly. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.